Eric, welcome back to F.A.C.E, buddy.
Can you hear me?
Got you now, Eric. How are
How
you?
are you? Doing excellent. How are you?
Good. Really interesting. People I use the word interesting when they can't think of anything else to describe an environment that's probably our grandfathers lived through things like this. So, do you want to share your screen?
Sure.
Okay. So, I get your emails, Eric, and the feature of your last email, tell me if I'm right on this, is that you're talking about real incomes falling at a pretty good clip. And is that because of higher prices that, wages aren't keeping up with inflation, or is it something else?
Well, it's a little bit of all of that. It's that we have declining growth and wages are ultimately tethered to growth. So you can't really have accelerating growth with accelerating wages with decelerating growth directionally. And then on top of that, we have prices that are continuing to rise in key goods. And by key goods, I mean goods without perfect substitutes. So the worst things to see rising prices would be food, fuel, and rent. So those are things that are
Right.
difficult to substitute on a short-term basis. So
Interesting.
that's what we're seeing the rise in to a lesser extent rent now, just because food and fuel has sort of stolen the show. But people's incomes aren't going to rise just because oil went to $111 a barrel, but they're still going to have to put fuel in their car. So their real discretionary income is going to continue declining. So that's problematic. And just to sort of set the stage before we, I guess move on to whatever else you'd like to discuss. I always show this chart, anytime I have a podcast or anytime I do an interview. This is sort of this is my coincident index, which takes a composite of what I call the four corners of the economy. So any economy, whether China, Japan, Europe, United States, they all have income, production, employment, and consumption. Those four factors are what make up an economy. So what I do is I take the most reliable measure from those four corners in real terms. This is real growth, combine them together, and I track the growth rate. And that's what you see here. This is not a leading index, so this doesn't tell us where the growth rate's heading. This just defines the trend. And I've shown this chart every time I've been on your show. The growth rate is very clearly been in a downtrend since April of 2021. March of 2021, depending on how the revisions come in every month, it kind of shifts. But the peak was March or April of 2021. The growth rate's been declining. So we've been in a growth rate cycle downturn since March of 2021. It's not an opinion. This is just what the data shows. And again, this doesn't tell us that the growth rate is going to, where the growth rate is going to go from here. For that, we have to use leading economic indicators, which is what I write about. And every time I've come on your show for the past 6 or 8 months, I've shown this chart and I said the leading indicators tell us that we're going to keep grinding lower. That's still the case today. So this chart is going to continue to grind lower over the next several months. So as we set the stage for whatever the next part of the conversation brings, we have to contextualize the fact that we're in a growth rate cycle downturn, and that downturn is likely to continue.
Okay, and have you ever done a study, Eric? I talked to a lot of smart people, and one analyst said that anytime oil prices have doubled, there's been a recession 6 to 12 months later. And this has been more than a double in WTI.
Yes. So where that chart becomes relevant is if we look at this chart here. So this chart, if you can see this on your screen, it's real personal income excluding transfer payments. So this is all sources of earned income in the economy. So basically all this does is take out what the government transfers to people, but this includes wages, interest income, rental income, sole proprietor income, you name it, everything except what the government sends to people in the form of checks. And if you go to the last expansion, this was growing at about a 2.9% rate in real terms, which wasn't the greatest, which is why the last recovery was so subpar, because the economy couldn't really generate strong real income growth. But as prices rise, specifically oil and food, we're seeing real incomes deteriorate. And if you can see, I don't know if my cursor is showing on the screen here, we're hooking down even more. Like, so we fell below the trend. We never regained the trend. And then we came up a little bit, and now we're rolling over even more.
Could I short it there? Any way I could get short?
Well, you could short the consumer. That's what the short would be. But
how do I do that? S&Ps?
So this gap here is now $650 billion. So what that means is the consumer. Let me roll back a step. Okay. In economics, there's a very important concept called long run income. So Dale, if you were going to buy a big ticket item like a house or a car or something like that, or even when you do any type of planning, you have a mental projection of sort of where you'll be in 2 to 3 years or 3 to 5 years, somewhere in that range. It gets fuzzy as you get a little bit further out, but somewhere in the ballpark of 2 to 4 years is where people mentally project out where they're going to be, which is why these trend lines are important. So if we're sitting back here in 2018, 2019, people were making decisions based on their projection of where they would be in 2020, 2021, 2022. And a lot of people thought they were going to be up here by the red line. And what's actually happening is they're settling down here at the black line. So this is a huge gap between where people thought they would be and where people are in real terms. And that essentially translates to demand destruction because...
Eric.
Yes.
Sorry if I may interject, Steve. When you say, I just have a question, right?
Yeah, please.
I'm mostly an economist myself as well. I've actually studied finance. I have a bachelor in finance and one in business administrator. But, I took a lot of lessons in economics because I really enjoyed them, and I am kind of a buff. When you say real personal income, I assume that also includes, retracting inflation from it, correct?
Correct.
Yeah. So now my next question comes. Do you believe that that reported inflation is
accurate,
or exactly at, or nearly what the actual inflation is?
I think the CPI does a relatively good job at tracking consumer prices.
Okay. So you think it's a rather accurate measure of prices?
Yeah, I mean, everyone's personal basket will be different. So if you look at what the CPI is tasked to do, it's tasked to ask what's the general rate of inflation across a broad basket of goods and services across everyone in the country. So if you live in San Francisco, you may look at the CPI and say it's not accurate, but that's not what the CPI is trying to do.
No, I totally agree with you.
If you live in Idaho, the CPI is going to be different than someone in San Francisco. If you live in New York City, the CPI is going to be different. So yes, I think it does a good job of tracking consumer prices across a
my problem being that substitutions and hedonic adjustments, in my opinion, do a very, very good job in masking inflation in many respects.
Okay, let me try a different angle here. Okay, this is real GDP per capita. So what you're basically saying is so over the last 20 years, real GDP has grown at 1% per annum. That's what this last point is showing.
Yes.
If you're taking the position that the CPI is understated, you're basically taking the same position that we've been in a depression for the last 20 years.
Yes. That's exactly what it is, indeed.
Okay, I take the position that the growth rate's deteriorating, and this deterioration from a trend growth of 2.25, 2.5, collapsing to 1% is what we're feeling. I think that a lot of people are falling below zero because you have to remember real GDP per capita is the average. That's the average of everyone in the country. So, and we also know that the wealth gap is very skewed. So this is not the median. This is not saying that 50% of people are above 1% and 50% of people are below 1%. This is saying that average is 1%. So if you have people like Jeff Bezos and Elon Musk that are growing 100% per year,
they make up for millions of people that are on the other side of the
correct.
equation.
So
in essence, what Eric says, because not everybody's right, very good at mathematics, there is a difference between the mean and the median. This is the mean, not the median.
Correct.
That's what you mean. It doesn't represent the average person. It just represents the mean of persons, which we know how skewed it is, as you said. And unfortunately, it has become a lot more skewed over the years, right?
Correct. So I concur with your statement that a large percentage of the population is below zero. If you look at real GDP per capita as the standard of living, because that's essentially what it is. What this chart says is that the mean standard of living is increasing at 1% per year. So if you take everyone in the country's standard of living is increasing at 1% per year over the last 20 years, which is horrible. But significant portions of the population are well below 1% and likely below zero. That's what I believe you're getting at. But I do believe that the inflation is relatively accurate as far as the task that it's trying to accomplish. And I think that when people feel like we've been in this depression, I'm not saying that their personal experience is incorrect, but I don't believe the country as an average has been in a declining standard of living for the last 20 years. I think that the growth rate in the standard of living is falling. And what you're picking up is an extremely important point. It's that everyone feels rates of change. If your standard of living is going up 2% and then it starts going up 1%, it's still going up, but you'll feel like you're going backwards. Yeah. It's a second derivative, which is why when I look at these cyclical trends, I always look at the second derivative or the change in the growth rate. You can't look at this and say growth is 3%. You have to look at it and say growth is declining, because people felt 8% here. Now they feel 3% here. They feel the decline in growth. Mm-hmm. It's the same exact thing as saying growth was 2.5% on a long-term basis. Now it's 1%. We feel like we're in a depression.
No, we agree with everything you said. I agree with everything you said. We're on the same page. It's just added to that. My belief is that inflation is understated, so growth is also overstated. So even this meager growth that we saw in many years has been actually, in my opinion, real negative growth. But of course, this is not something that we can solve on this show, because it's so subtle, it's so easy to change a reported inflation rate of, let's say, 2%, if we take past years, to like 3.5%. which it is very easy to do and very hard to refute one way or the other. You know what I mean? It's just that I believe that all the methods of readjusting inflation.
Well, we have other measures to corroborate what's going on, such as gold prices, which is priced essentially off the real interest rate. If real interest rates were 400 or 500 basis points lower than what they're reported at, we'd likely have seen gold make a new high since 2012, but it hasn't, which has perplexed a lot of the people that believe that we have hyperinflation or runaway inflation. So there are a lot of asset prices and other means that we can corroborate this inflation rate. So I generally believe that it's as close to accurate as we can get. It's not perfect. It's an impossible task to nail it perfectly, but gold prices are lower than they were 10 years ago. They're rising now, and because but if the real interest rates were 100, 200, 300 basis points lower because inflation is 300, 400, 500 basis points higher, then it makes no sense that gold is lower than 10 years ago.
Yeah, but if you take in gold as a sole indicator about that, then even if we take the reported inflation, which is currently 7.5% almost, right? Then the price of gold where it currently is doesn't make any sense in comparison to where the price of gold was when reported inflation a couple of years ago was 2%.
It does, because gold is a long duration security. Gold has an effective duration in the range of 15 to 20 years. And if we look at the inflation expectations 15 to 20 years out, they're still well anchored at 2%. So again, you have the bond market, the treasury market, that's corroborating long-term inflation expectations around 2%.
Yeah, for which the biggest buyer, though, remains the central bank. which is
No,
kind
come
of
on.
my
All right,
problem.
all right, all right. We can go through this all day, but the Fed's not buying anymore. Why
Yes.
is the rate still falling? The Fed didn't buy
It's buying
from
less at the moment.
2014 to 2000. No, they're not buying as of March. They're not buying. So why or the Fed didn't buy from 2014 to 2019? Their balance sheet actually contracted. The rate didn't go up. The Fed wasn't buying from 1980 to 2009. The rate went down.
Baked in the expectations, though, is that the Fed is going to keep buying whenever there is trouble. So let's see what happens
Was
in
there
a
an
world.
expectation that the Fed was going to? Okay.
Anyhow,
Is the rate buying? Is the rate buying because of the Fed, or is the rate buying because demographics are pulling interest rates lower?
Both, in my opinion.
Why did the rate fall from 1980 to 2009 when the Fed was not buying and there was the word quantitative easing didn't exist?
Great question.
First of all, in the 80s, we had in essence the last period of history that we had actual booming growth again, right? Post Volcker and post Reagan, and then we had the internet in the 90s. So we had in essence a period of like roughly 15, almost 20 years that we had some kind of prosperity, let's say, right?
So you're saying that nominal GDP growth is tied to labor force growth, right? Based on this chart? Nominal GDP growth in black, labor force growth in blue.
Okay, yes.
Okay. Do you believe that interest rates are tied to nominal growth?
Nominal growth. Yes, somewhat. Depends.
Okay, here comes checkmate.
I mean, how could you look at this chart? I mean, okay, so nominal growth, labor force growth.
Mm-hmm.
Labor force growth, interest rates.
Mm-hmm.
Are you correlated?
Where's your issue?
They are, absolutely.
So what changed? Point me to the spot on this chart where quantitative easing began.
So you think that quantitative easing?
I think quantitative easing drives interest rates up, not down.
Why would that be?
Go back to every single period where the Fed was doing quantitative easing. Interest rates rose. They didn't decline. Every time the Fed stopped quantitative easing, interest rates declined.
Yeah, but that also has to do with the market's mechanism of pricing in expected outcomes, right? Because
bingo. So when the Fed does quantitative easing, people believe that inflation expectations are going to go up, that we're going to achieve prosperity, asset prices are going to go up. So inflation expectations rise.
And before it does quantitative easing,
interest rates go up.
Yeah, and before quantitative easing, with the exception of the first time, it has also photographed or prepared the market of what it's going to do. So the market is already pricing in what's going to happen.
Okay. Well, I'll take the side that nominal growth is what drives long-term interest rates, and nominal growth is driven by debt and demographics. I'll give you. All right, Dale. I'll ask you a question. If I told you a year ago, and I think I was on your show a year ago,
that we've been talking for a while.
Oil prices were going to go from 60 to 115. CPI was going to go from 2 to 7. The Fed was going to stop quantitative easing, and we were going to go from 0 interest rates priced into the Treasury curve to 6 interest rates priced into the Treasury curve. Right? That's the setup that I told you was going to happen. Would you say 30-year rates would be higher or lower?
Oh, yeah, higher.
Well, they went from 2.50 a year ago
down
to 2.15.
Yeah.
Why is that? The Fed's not buying. The Fed bought $10 billion last month. We're talking less than $1 billion a day in a market that has $600 billion of daily volume.
There's been a huge flow of funds into the bond market. Could it be foreign buyers making up that difference from the Fed? Who do you feel, where's the money flow coming from to replace Fed buying, Eric? Do you have an idea?
It's coming from vast amounts of sources. It's
Okay.
coming from private sector banks. It's coming from foreign banks. It's coming from private sector. My point is, we have to step back and understand that there's more going on to this equation than oil prices oil prices doubled, 30-year rates went down. Inflation went from 2 to 7.5. Interest rates went down. The Fed was a buyer of 120 billion a month to zero. Interest rates went down. I'll give you another example. The Fed was doing $120 billion a month of quantitative easing, over $1 trillion a year. And interest rates went from 50 basis points on the 10-year to almost 2%. How did interest rates quadruple while the Fed was buying $1 trillion a year? And then when they stopped, they came down. When did interest rates peak, Dale? When did 30-year interest rates peak? March of 2021.
Yeah.
When did growth peak? March of 2021.
So rates are more, so it's more of the market moving rates towards declining
30-year
growth.
interest rates are the most economically sensitive indicator we have.
Yeah.
It's not controlled by the Federal Reserve.
Right.
It's controlled by expectations of growth and expectations of inflation.
And that's why it's been flattening.
And exactly right. That is exactly why the curve has been flattening. It's exactly right.
I have one request from.
By the way, I love that discussion. I appreciate
it was great.
the back and forth. No, that was good. I like that.
Yeah, I mean, you and Steve, that you ought to think about that.
Maybe we'll do a podcast.
Summit. Yeah. So I did have a request from an attendee. They asked if you could show the factor coincidence index for China before you go.
I don't have that indicator relatively readily available for China.
Okay.
What I do have is a more secular chart. So that's the cyclical trend. This is secular conditions. So this is, again, going back to these demographics. The only thing I would point out is that the working age population, 15 to 64, is what basically is the engine of economic growth. Why is that? It's because consumption increases from 25 to 54, and then consumption starts to tail off, right?
Yeah.
Pretty basic.
Yeah.
If we go to housing and vehicles, it actually peaks even earlier. So you need an economy that's very vibrant in 25 to 64-year-olds, preferably 25 to 54-year-olds. You need a very vibrant economy in that age cohort to drive economic growth. If we go to the major economies of the world, what do we see? We see the working age population started to contract in Japan in the 1990s. Japan went to 0% interest rates and they never got off, right?
Yeah.
In 2009, Europe went to contracting working age population. They went to 0 or negative interest rates. They never got off. 2015, China went to negative working age population growth. And there's a lot of reasons to believe that the China demographics are overstated. The number is actually even lower, but let's take it for what it is. 2015. What happened in 2015 in China? They did their first major devaluation of the yuan, August 2015, right? We had Dow opened down like 2,000 points that day. They tried to reflate their property bubble again, but point being is that it's not a surprise, Dale, that with a negative working age population, what are the headlines in China today? Real estate, right?
Yeah. This is all based on, so the demographic picture still looks the best in the U.S.?
That's right. And these are estimates from 2019. The numbers that are coming in for the United States over the last 2 years are coming in way lower than this dotted black line. So the demographics are deteriorating faster than the projections, but it's deteriorating everywhere faster than the projections. So China, Europe, and Japan for the next 10 years are going to have declining working age population. That's going to be insurmountable for their economies to overcome. Japan's never gotten off a 0 or negative. Europe's never gotten off a 0 or negative. China's going to have to figure out what they're going to do with their property situation because their economy is based on building apartment buildings, of which there will be less people to fill now, right? Yeah. The U.S., this line, the dotted black line, slightly overstated. So we're going to be basically at 0, perhaps even slightly negative working age population as well. So that's
seems now post-COVID, Eric. Is that also a factor?
It is.
People leave the Great Resignation.
Yeah, and this doesn't include people by working age population, I don't mean people employed. I mean actual bodies.
Okay.
Labor force labor force is even lower, but this is just the pure number of bodies, whether you're actually working or not. This is just the working age. So when we're looking at this long-term 30-year interest rate and we're saying, well, why can't this rate go up despite oil prices doubling, the Fed ending quantitative easing, interest rates rising on the short end? It's because it's a long duration security. It's based on the next 30 years, not the next 2 years. And baked into the expectation of this long-term security is how the hell is, or better yet, who's going to be the engine of economic growth going forward?
So let me ask you this: with the real estate market in a huge bubble, bigger than we had in 2008, and these demographic trends, and houses don't die, could this be another just, do you think that the demographics are going to pop the real estate bubble?
Well, there are definitely different dynamics in this real estate market than there were in 2008. 2008. One example would be, I know we're running out of time here. This is household debt to GDP. So households aren't quite as levered as they were then.
Okay.
So that's one thing. Another thing is that a lot of households were extremely levered on adjustable rate mortgages.
Yeah.
There's less adjustable rate mortgages now. So I don't believe that the housing is the same time bomb that it was back then. But the other thing that I would like to point out, I always try and make this disclaimer when I talk about real estate, is that it's a very regional market. The two things that impact real estate are incomes and demographics. So if I come on here and paint a negative picture for real estate and somebody lives in a market like, Palm Beach, Florida, and they say, well, my real estate market's booming. Granted, there's been over 1 million people that have moved to Florida in the past 3 years. So the demographics in Florida are quite robust, right? So I don't want to make any characterizations about anyone's local real estate market, because they could be in an area of the country that's experiencing very positive demographics. So they have more bodies, and the people that are moving there are high income. So you have higher incomes, better demographics. It would make sense to have a local boom in that real estate market. All I'm trying to say is that nationally, we have declining real income and we have declining working age population. That's going to set up a difficult situation for real estate as a whole. And if I could show one more chart before you kick me off here, this would be a leading indicator of economic growth. So I showed the coincident indicator. This is a leading indicator. So this tells us where we're going. And what is that? This is private borrowing rates. An 18-month change. Private borrowing rates is a composite that I put together that includes corporate borrowing rates as well as mortgage rates. We know mortgage rates have gone up quite a bit. And what this chart is basically showing, it's an 18-month change, is that private borrowing rates collectively have spiked over 100 basis points in the last 18 months. Historically, that leads to some problems.
Okay. And I tell you what, people want to hear you talk for another hour. You could do a course. Everyone wants you to be their economics professor, Eric. Really, enlightening. People are asking if they can see it again. Yes, it is recorded, and people want to know your Twitter handle. So
I think I have. Oops.
EPB research.
Yeah, let me see. Did my screen share go away?
There you go. No. There's all your stuff.
Okay.
Okay. There's where you could find Eric. One of the very good minds when it comes to economy. And I did. There were times where Steve really didn't have a response, and that's also a rarity. But Steve, you were right. I've been in a depression for about 20 years. So anyway, that was a great call by you. And
no, that was an awesome discussion. I really appreciate it.
The thing is that I agree on everything with Eric. It's just not, I just don't trust official inflation that much. So our only disagreement is where the baseline is, not where growth is heading.
Directionally, rate of change, we're on the same page for sure.
Yeah, exactly on the same page. Yeah.
And I'd like some help with my
with your depression.
My chronic depression, and there's nothing like money that kind of makes me happy for a little while. So anyway,
nothing.
You know what? I'm not depressed because I'm grateful for this interviews, and you can't be depressed and grateful simultaneously. So Eric, thank you so much, buddy.
Dale, that was awesome. Thanks for the conversation.
Yeah.
I really enjoyed that.
Thank you.
Let's push this video and enlighten the Finchwood
it's going to be out in around 3 hours on YouTube, as always.
And Steve, thank you for your great job as co-anchor today.
Oh, it's always my pleasure.
Okay, and I just went out and got some breakfast.
No, I'm glad you chimed in and turned it into a conversation versus having me rant into oblivion.
I'll be more than happy to do it again.
You don't rant, you edify, Eric. So I'll see everyone later.
Bye-bye.
You could join the team in 12 minutes on the morning edge. Good hunting today, and remember, trade with less leverage and let your stops breathe. Talk to you later.
Bye.
Adios.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.